Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and we've seen some interesting action. I think really I'd summarize the situation at the moment as stocks rolling over to the downside and beginning to accelerate to the downside. In Australia, CPI data's out. People like that the headlines dropped significantly, but still has a 7 in front of it, 7.0% for Australia's CPI data today. But there are undercurrents within that suggest Australia's pricing pressures remain somewhat alarming, actually. So it may not be the simplistic knee-jerk response of lower headline means everything's okay, but certainly the market took it that way. First of all, the US stock market, you'll remember I put out a report recently where I said the most likely course of events was a slow motion rollover top for the US stock market. That's definitely what we have continued to see there. And then yesterday in New York, we saw that sort of the biggest actual kind of price shift in either direction for some time. We've had big swings within the day, but that was a very strong, emphatic move to the downside. Microsoft earnings came out after the bell, and that helped stabilize the futures market, but I don't think it's going to be enough to turn this freight train of selling, which is what I expect to develop, to turn that around. I don't think, though, it's going to be an easy short US stocks and they just simply fall away. It's going to be a very jagged effect, a jagged decline with significant rallies on occasion, both intraday and over several days as we move lower. I do believe it's a trend to the downside because global growth is slowing and the US economy, in my view, remains distraught, with the only good data really being employment data, but that is a fudge because, as I've said numerous times, that doesn't include the 2.6 million American workers who have not returned to the workforce since COVID ended. Probably that number might be a little bit lower as some of those business ideas might sort of run amok and people come back to the workforce. But let's hope they're all successful or happily retired. But it means that the employment numbers in the US have looked stronger than they actually are, which leaves really a dearth of economic data that points to the downside. Continued plateauing at best, but probably still softening US economy, and certainly the global economy continues to slow. And we've had a ratcheting up of tensions over Ukraine and with China over Taiwan. So there's going to be ongoing problems here, and things will not go the way the market expects in some of these theaters. So be careful for some surprises to markets. Markets have become a little bit complacent about the various risks that are out there, and we've certainly seen some resurgence in energy prices, although for the moment that risk has dissipated with those sharp declines in oil prices over the last few days. But I do think that we're going to see a stabilization of inflation in the US nonetheless, and the banking crisis in the US is back front and center, with First Republic in releasing its earnings showing a loss of 41% of its deposits and a fresh 40% decline in its share price. There are still hidden problems out there in the American banking world. Coming to Australia's CPI data now, stocks went up, the Australian dollar declined as the headline number dropped, but there was some devil in the detail. For instance, the services sector growth actually went up to 6.1%. The rate of goods inflation is declining. The rate of services inflation is actually on the rise. So in a sense, and actually it is, services inflation is replacing the previous goods inflation we saw, which means the overall numbers, and especially with that 1.4% monthly result, the numbers remain stickily high. And so the Reserve Bank will be a little bit, to be honest, not as the market reacted. The RBA will be a little bit panicked by what it saw in those numbers today, especially that huge surge in energy prices, electricity and gas prices rising 26.2%. That's absolutely ridiculous when we're a major energy producer in terms of gas in Australia, but that's a whole nother conversation. But certainly there are problems there for Australian households in dealing with this price inflation. So really, even though inflation is going to remain sticky and strong, should the RBA be raising rates any further, I don't think so. I think there is a risk they will, because that's been their modus operandi previously. And if you just look at the RBA as its previous animal before the review, and knowing that it will be critiqued more accurately moving forward, it may hold off on a rate hike at the next meeting, but the old RBA would have certainly been hiking rates at the next meeting now on the basis of today's CPI data, even though the market liked it. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.